Look, I need to be straight with you about something happening right now in the silver markets that honestly has my full attention. We're seeing price action that I haven't witnessed in years, and if you're invested in precious metals or you've been watching these markets like I have, you need to understand what's unfolding here, because this could represent a fundamental shift in how silver gets priced globally. So here's what's happening. Asian markets opened up on Monday morning, and within the first couple hours of trading, silver on the Shanghai Futures Exchange absolutely exploded higher. We're talking about prices hitting around $125 per ounce. Now, I want you to really absorb that number for a second, because when you compare it to what's trading over here on the Comex, we're looking at roughly a $15 to $17 premium. That's not a small discrepancy. That's a massive gap that tells me something structural is breaking down in the global pricing mechanism for this metal. When I woke up this morning and started going through the overnight price action, silver had already ripped higher by about $6, and American traders hadn't even gotten to their desks yet. The kind of momentum we're seeing here isn't your typical volatility. This is the physical market essentially screaming at the paper market that the old system of price discovery might be falling apart right in front of us. Let me walk you through why this matters so much. Under normal market conditions, when you see a price differential this large between two major exchanges, arbitrage traders should be able to step in, buy the cheaper metal on Comex, ship it over to Shanghai, sell it there, and pocket the difference minus their costs. That's basic market mechanics. But here's the thing that's got my attention. That's not happening fast enough. And when arbitrage opportunities this obvious don't get closed quickly, it tells you that physical metal isn't moving freely. Either the supply isn't there in the quantities needed, or the logistics can't keep pace with demand, or quite possibly both situations are happening simultaneously. This premium didn't just materialize overnight either. If you've been following my coverage over the past several months, we've been tracking how China has been systematically tightening export controls on critical metals, building up their strategic reserves, and we've watched Western inventories steadily drain lower. What Shanghai is doing right now is essentially bypassing Comex price discovery entirely and saying they're going to pay whatever they need to pay to secure physical metal. That's a really significant development when you think about the implications. Now let's talk about the Comex registered inventories, because this is where things get interesting. The registered silver, which is the actual metal available for delivery against futures contracts, has been trending downward for months, while open interest has remained elevated. Every time we see delivery pressure, more ounces get reclassified or withdrawn from the system. Shanghai is effectively telling the market that they value physical metal significantly higher than what paper contracts in New York or London are suggesting it's worth. From a technical perspective, silver just blasted through resistance levels like they weren't even there. The shorter timeframe indicators are showing extremely overbought conditions, but when I look at the weekly and monthly charts, we're still in what appears to be the early stages of a major breakout from a multi-year consolidation pattern. The volume accompanying this move is substantial too. This isn't some low liquidity spike that's going to get reversed in the next trading session. We're looking at institutional and quite possibly sovereign level buying here. Here's what should really concern anyone who still believes that Comex sets the global price for silver. If Shanghai can maintain a $15 to $17 premium over Western exchanges, it means the physical market in the world's largest manufacturing economy has effectively decoupled from Western paper pricing. That's not a temporary dislocation that gets resolved in a few days. That's a structural shift in how silver gets valued on a global basis. China is the largest consumer of silver for industrial applications. We're talking about solar panels, electronics, electric vehicles, 5G infrastructure build-out. All of these require significant amounts of silver. If Chinese buyers are willing to pay $125 per ounce, they're either desperate for supply or they understand something about future availability that Western markets haven't fully grasped yet. Probably both. Now let's connect this to the bigger macro picture, because nothing happens in isolation. We're in the middle of a global competition to secure critical materials, and silver isn't just a monetary asset or something for speculators to trade. It's a strategic industrial metal with virtually no substitute in most of its applications. You cannot build solar panels without silver. You cannot manufacture high-efficiency electronics without it. The energy transition that every major economy is publicly committed to pursuing requires silver in quantities that current mine supply simply cannot meet. The geopolitical dimension here is absolutely critical to understand. China implemented export controls on critical metals. The United States is pushing for reshoring and onshoring of manufacturing. Tariffs are being used as economic weapons, and supply chains are fragmenting along geopolitical fault lines. In this environment, a $15 to $17 premium in Shanghai isn't just about traditional supply and demand dynamics. This is about strategic stockpiling. This is about making sure you have domestic supply in a world where you can't necessarily rely on global markets to deliver what you need when you need it. Here's something that should really make you sit up and pay attention. This Shanghai premium spike is happening while Western institutional investors are largely absent from the silver market. Hedge funds, pension funds, sovereign wealth funds outside of Asia have been underweight precious metals for years now. If this price action in Shanghai forces a reassessment of that positioning, if it triggers fear of missing out, or strategic allocation shifts in Western financial institutions, we're not going to be talking about a $15 to $17 premium anymore. We could be looking at a global repricing of silver across all markets. Let me paint a scenario for you. Asian buyers are paying $125. Comex is trading around 110. Western funds start buying futures contracts either to capture the arbitrage opportunity or to hedge supply risk. Comex inventories can't meet the delivery demand. Premiums on physical metal in New York and London start climbing higher. Backwardation, where spot prices exceed futures prices, becomes persistent instead of just occasional. At that point, the paper market loses its credibility as a price-setting mechanism, and we enter true price discovery based on physical availability rather than derivatives trading. Now, I want to address the other side of this because we have to maintain discipline and consider what could go wrong with this thesis. This move could reverse. This could be a short squeeze. This could be a liquidity event that gets unwound when Asia closes and New York opens for business. That's absolutely possible, and it's the kind of thinking we need to maintain. If this is purely a Shanghai-specific squeeze driven by a few large buyers or some kind of technical default situation on their futures exchange, that premium could collapse as quickly as it appeared. We've seen flash premiums before in other commodities when a single contract or warehouse facility has issues. If metal starts flowing back into global markets from Shanghai, that $17 gap could close fast. The paper markets have absorbed massive shocks before without completely breaking. Comex has regulatory tools at their disposal. They can raise margin requirements. They can halt trading temporarily. They can settle contracts in cash if physical delivery becomes impossible. The concentrated short positions that we've been tracking through the commitment of traders data, those players have extremely deep pockets and regulatory connections. They've managed to suppress silver rallies for decades. I wouldn't underestimate their ability to cap this move. If this price increase happens too fast, it could trigger profit-taking and technical selling. Traders who bought silver at $90 or $95 are sitting on massive gains right now. The temptation to lock in 20 to 30% profits in a matter of days is very real for short-term traders, and that selling pressure could stall the rally even if the fundamental shortage story is legitimate. Macro conditions could shift suddenly too. If the dollar strengthens unexpectedly on Federal Reserve policy changes, or if we get a risk-off sentiment wave hitting global markets, silver could get sold alongside other risk assets regardless of the underlying supply-demand fundamentals. We're in a fragile macro environment with multiple potential shock points, and any of these could derail a commodity rally. I need to give you full risk disclosure here. Silver is an extremely volatile market. If you're not prepared psychologically and financially for a $20 swing in either direction over the course of a week, you probably shouldn't be trading this market. If you're using leverage, if you're trading on margin, if you're using money you genuinely can't afford to lose, this is absolutely not the time to be chasing a rally. The risk of a violent correction is very real. But despite all those legitimate risks, here's why the bullish case is actually escalating in my view. The Shanghai premium isn't happening in isolation. Look at what's been building for months. Comex inventories declining steadily. London Metal Exchange inventories flat to down. Shanghai Gold Exchange showing elevated premiums for gold as well. Central banks globally continuing to purchase gold at record pace. Industrial demand for silver outpacing mine supply by a widening margin every single year. Geopolitical fragmentation making cross-border metal flows increasingly unreliable. This isn't one isolated data point. This is a convergence of multiple trends all pointing in the same direction. That $15 to $17 Shanghai premium is the visible symptom of a supply crisis that's been developing beneath the surface of these markets. If China is willing to pay that kind of premium, it signals they believe that securing availability at any price is more important than waiting around for cheaper metal that might never materialize. The solar build-out in China alone requires hundreds of millions of ounces of silver annually. The electric vehicle transition is still in its early stages. AI data centers need silver for high-performance computing applications. Military and defense uses are non-discretionary. These aren't speculative demands that disappear when prices rise. These are structural, non-negotiable uses that continue regardless of price levels. Here's what really matters. If Comex tries to suppress the price while Shanghai is paying $125, the arbitrage flows will drain Comex inventories even faster. You cannot maintain a $17 pricing disconnect for an extended period without physical metal flowing to the higher-priced market. And if Comex doesn't have the metal to deliver against contracts, the entire paper pricing structure starts to fracture. We could be watching the early stages of a global silver market reset happening in real time. The era of Comex and the London Bullion Market Association setting the price, while Asian physical buyers just accept it, might be coming to an end. Shanghai is saying they'll pay what they need to pay, and if Western exchanges want to continue their paper trading games, fine, but the physical metal is going to flow to wherever values it most highly. For anyone holding physical silver, this is validation of what you've probably suspected for a while. The premiums you've been paying over spot prices for months now, those weren't dealers gouging you. That was the market trying to signal that physical metal is worth more than paper prices suggest. Now, Shanghai is confirming that at the institutional and sovereign level. The key things I'm watching this week are Comex registered inventories, premiums on physical coins and bars from dealers, and whether London and New York prices start converging with Shanghai or if that gap widens even further. This isn't the time to be complacent about your positions or your strategy. We could be witnessing a historic inflection point in how precious metals get priced globally, and that has implications for every investor in this space.